What is inflation? Rise in prices means decline in the purchasing power over time. This phenomenon is called inflation. When the purchasing power drops and price rises, oftenly expressed as a percentage, means that the currency is losing its value and now buys less than what it used to. Deflation, on the other hand, occurs when prices fall and the purchasing power rises. The rate at which the prices and services increase is inflation. There are three types of inflation: demand pull inflation, cost push inflation, built-in inflation. The most common inflation indexes are the Consumer Price Index and the Wholesale Price Index. Inflation can be positive or negative depending on the individual and the rate of its change. Businesses that own tangible assets like real estate or stored products enjoy inflation as it raises the value of their assets. Understanding inflation. It is easier to understand the price increase in one or two products, but since a normal human being requires multiple products and services for a comfortable life, including wheat, meat, milk, eggs, and energy like fuel, electricity, and traveling, it certainly is tough for a common person to make his ends meet during the inflation. Healthcare, entertainment, and labor become luxuries not everyone can afford. Inflation measures the price changes and represents the increase in price of goods and services in an economy over a certain period of time. 8.3% is the change in the Consumer Price Index over the 12-month period that ends in August 2022. If you consider food and energy, it rose 0.6% compared to 0.3% in July over a 12-month time. Price rising means that each unit of money now buys less product services. This loss of purchasers impacts the living of a common person, which eventually leads to slowing down a country's economy. The economists agree inflation occurs when a government's money supply is greater than their economic growth. In order to fight inflation, the monetary authority, central or state bank, of a government controls the money supply and credit to control the inflation so that the economy keeps running smoothly instead of coming to a halt. What is monetarism? Monetarism is an economic theory holding that variations in unemployment and the rate of inflation are usually caused by changes in the supply of money. This popular theory explains the relation between money supply of an economy and inflation. For example, history tells us that after a conquest, the triumphant party brings massive amounts of gold and silver from the defeated party. Since the money supply increases drastically, the value of money drops, which later leads to a rise in prices. Inflation has a variety of types. It is opposite of deflation but usually misunderstood with disinflation. Disinflation refers to slowing down the positive rate of inflation. Cause of inflation. Increase in the money supply is the root cause of inflation, but there are certain reasons that a country's money supply is increased, like printing more money and giving it to the citizens. Legally devalue the tender currency. Loaning new money as reserve account credits. But most common way is purchasing government bonds from secondary market. In all these cases, the money loses its value and hence the prices accelerate with people losing purchasing power. Types of inflation. Inflation has three types: demand pull inflation, cost push inflation, built-in inflation. Demand pull inflation. Demand pull inflation is a result when increase in money supply credit creates higher demand for goods and services. This increase in demand leads to prices rising. With more money, people try to spend more freely. It creates a gap between supply and demand as the demand is higher with inflexible supply. This results in higher prices and thus demand pull inflation occurs. Cost push inflation. Cost push inflation occurs when the production process sees a hike in cost. When money supply credit is transferred to a product or any other asset, cost of all kinds of goods rise. It is more prominent when an already struggling economy takes another hit. This leads to higher cost for the product or service and therefore increasing the price. For instance, when money supply is increased, it creates a speculative price hike in oil prices. This intends that the cost of oil can rise and contributing with rising prices. Built-in inflation. Built-in inflation happens when people expect that the inflation will keep increasing. This prediction of prices to keep increasing in future at the same rate leads them to ask for higher prices for goods and services. For example, workers may ask for higher wages to maintain their standard of living. This contributes in higher prices for the goods as it is intertwined with the wages, and one factor leads to another, eventually increasing the cost. Types of price indexes. The statistical estimate of price change for a basket of goods and services are calculated and tracked as price indexes. The most common price indexes are Consumer Price Index (CPI), Wholesale Price Index (WPI), the Consumer Price Index (CPI). The CPI is the measure of average price of a basket of goods and services purchased by the households. This includes food, healthcare, and transportation. It is calculated by taking price change for each item in the basket, goods and services, and averaging them based on their weight in the whole basket. It is one of the most commonly used statistical estimate for calculating periods of inflation or deflation. Changes in CPI assess the price change associated with the cost of living. The United States Bureau of Labor Statistics (BLS) reports CPI every month and has the record of calculated CPI as far back as 1913. The Wholesale Price Index (WPI). The WPI is another statistical measure of inflation. It calculates the change in price of goods before the retail level. It varies from one country to another but mostly include items at the wholesale level. For example, it includes the cotton prices for raw, yarn, gray and cotton clothing. Many countries use WPI with exceptions of some, including United States, as they use a similar version called Producer Price Index (PPI). The Producer Price Index (PPI). The PPI calculates and measures the average change in selling prices received by producers. It measures the price changes from the seller and differs from CPI, which measures the change in price from a buyer's perspective. The formula to measure inflation. The versions of price indexes mentioned above are used to calculate the inflation value between months or years. Ready-made inflation calculators are available on different financial websites, but it is always better to know the methodology to understand accurately with proper calculations. Percent inflation rate equals final CPI index value divided by initial CPI value multiplied by 100. For example, you wish to know how the power of purchasing has changed from September 1975 to September 2018. From websites it is easily found that for September 1975, initial CPI value was 54.6, and similarly for September 2018, the final CPI value is 252.439. Putting the values in the formula mentioned above. Percent inflation rate equals 252.439 divided by 54.6 multiplied by 100 is equal to 4.6234 multiplied by 100 equals 462.34%. Now to know how much a $10,000 worth from September 1975 to September 2018, multiply the inflation rate by the amount. Change in dollar value equals 4.6234 multiplied by $10,000 equals $46,234. Simple words, the $10,000 will be worth $46,234.25 in September 2018. Similarly, if you bought a basket of goods and services worth $10,000 in September 1975, the same basket of goods and services in September 2018 will be worth $46,234.25. Advantages and disadvantages of inflation. Inflation has its advantages and disadvantages because it mostly depends on the asset that you are holding. Pros: assets like real estate or stocked goods can see a price hike, and the individuals associated with such assets will always want to see inflation to be able to sell their assets on a higher rate. The most favorable level of inflation is encouraged to spend certain extent instead of saving. If the purchasing power falls, then there might be a greater incentive to spend instead of saving. Increase in spending may contribute in balancing the economy of a country. The best move is considered keeping the inflation at a desirable range. In short, inflation leads to higher spending, which is eventually good for the economy. Cons. The holders of home currency take the biggest hit during inflation, as they lose the value of the money. People who hold assets like cash and bonds lose their value during inflation. To avoid getting stuck in situations like these, the investors prefer investing in inflation hedge asset classes like gold, commodities, and real estate investment trusts REITs. High inflation can hurt anyone from a small business owner to a country's economy. Businesses, workers, and consumers must be careful, with the general raise in the prices, with their buying or selling decision-making. The planning to tackle inflation depends on the future prediction of the inflation, and if it goes wrong, the time and resources expended on research and planning can cost a lot. That is why sometimes low and favorable rate of inflation can lead to cost serious issues with the economy. Because of how, where, and when the new money enters. Another disadvantage is that inflation drives up some prices first and some later. This sequence in purchasing power and prices, which is known as Cantillon effect, means that it not only increases the price level but also distorts the relative prices and wages. Economists understand this process to be bad for the economy, and Austrian economists believe it to be the major factor contributing towards the recession of a country. Controlling inflation. One of the biggest responsibility of a government is to keep the inflation in control. It is possible by implementing better monetary policies. This responsibility falls majorly on the central state bank that determines the rate of growth of money supply. A country's financial regulator shoulders the important responsibility of keeping inflation in check. It is done by implementing measures through monetary policy, which refers to the actions of a central bank or other committees that determine the size and rate of growth of the money supply. In the United States, the federal monetary policy revolves around long-term interest rates, ensuring price stability and maximum employment. These set of goals are aimed to promote stable financial environment. The Federal Reserve predicts long-term inflation in order to keep the economy steady. Ensuring price stability helps the businesses to plan for the future accordingly. This promotes maximum employment, but it does not mean zero unemployment, but instead it means there is a certain level of volatility with people leaving old jobs and looking for a new one. When economy is in dire condition, the monetary authorities step up with extraordinary measures. For example, during the 2008 financial crisis, the United States Feds pursued a bond buying program with near to zero interests called quantitative easing. It received backlash from many who believed it would increase the inflation, but it declined over the course of 8 years. The United States policymakers attempted to keep the inflation rate at around 2% per year. Countries who experience higher growth can absorb higher rates of inflation. For example, India's target is 4%, with upper tolerance of 6% and lower of 2%. Similarly, Brazil's target is 3.5%. With upper tolerance at 5% and lower of 2%. Hedging against inflation. Stocks are considered the best hedge against inflation, as inflation increases the price of stocks. In addition to that, people realize they are losing the value of the money and invested in stocks. This process magnifies the stock prices even further. Special financial instruments exist to save investments during inflation. This includes Treasury inflation-protected securities TIPS. Low-risk Treasury security is where the invested amount is increased by the percentage of inflation. With a brokerage account, you will have access to exchange-traded fund ETF. Choosing a stockbroker is a slow process because many exist in the market. But it is certainly better to invest in stocks or cryptocurrency instead of keeping the money in your bank account. Gold is considered to be a hedge against inflation, but it has proved that wrong many times in the past. Extreme examples of inflation. All the fiat money in the world can be manipulated easily. Politicians may allow printing more money for personal gains, resulting in inflation. German Weimar Republic in 1920 is the most famous example of hyperinflation. The victorious nations during World War I demanded compensations from Germany. Germany printed more paper notes and bought foreign currency with it, paying off their debt. This led into devaluating the German mark. German consumers tried to spend their money as quickly as possible, realizing it will be worth less and less every day. The economy eventually choked to a point where the bills were so worthless that people practically started to use them as wallpapers. Later, Peru in 1990 and Zimbabwe in 2007 went through the same effects of hyperinflation. Why is inflation so high right now? 2022 has seen the highest inflation rates in United States history since the 1980s. There is no single culprit that caused such rapid increase in global prices. A series of events are major factors towards it, especially the COVID-19 pandemic that led to lockdowns and closing of factories, greatly disturbed the global economies. Increased unemployment benefits from the governments to help individuals and small businesses was another factor towards it. Another major factor was Russia-Ukraine war in early 2022. Russia faces economic and trade sanctions that resulted in fuel shortage all around the globe, since Russia is a heavy producer of energy. Similarly, food prices increases as Ukraine is the largest grain harvester and wheat exports came to a halt. Essentially, increase in fuel and food prices led to increase in other prices as well. This is Michelle and you are looking at the www.opinionsonline.org blog post. Please like and comment for more videos. Thank you.